Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. I am very happy to be joined by Eric Pachman, Chief Analytics Officer of Bank Creek Capital Advisors. Eric, welcome to Forward Guidance.
Thank you so much, Jack. Thank you for having me.
Eric, we first got in touch based on your work, which really is incredible, about the differences between CPI inflation, which mainstream news organizations talk about, and PCE inflation, which the Federal Reserve that's their official target, and those different weightings and the different contributors to that. But let's hold off on that for just a minute, because I want to talk to you about the May employment number, the non-farm payroll, which came out in 272,000 jobs added, above forecast. So, the market took that as, bonds selling off, stocks initially selling off and rallying. What is your work on this? Tell us about your work.
Well, so let me back up a little bit. And have you seen the movie Inception?
Yes.
Hopefully everybody has seen this movie. It's wonderful. So, when you're like a one dream down, and then two, and then three, and then four. And once you get like 4, 5, 6 dreams down, like you almost never make it out and you get trapped. That's been my life for like the past 2 to 3 weeks. So I've had this podcast kind of on my calendar and really, really wanted to get this labor project done before we talked, because I was just fascinated by this database. And I have been pulling my hair out trying to get the visualization tool up on our website. And I'm proud to say that it is literally now up as of 1 hour ago. So anyone can go to our website. There's no paywall. It's free for anyone to use. And I've defaulted it to May data. And then we'll get into this, but display level 2. So you'll be able to see kind of like private education and healthcare and stuff like that. But you'll see the number. I mean, it ties to the 272. And then the idea is that I can come in here and tell you what I think about it. But I think it's more powerful for listeners to actually go through this and see, okay, there's the 272. Well, if I drill down to level 1 level deeper in the hierarchy, here's what, service providing is, and then level 2, 3, 4, 5, 6, all the way down to level 7. And you can get into some seriously deep levels of the dreams, which you may never emerge out of, like me. There was a really good article by Bloomberg kind of going into it. I was on pins and needles going into this, right? Because I'm like, oh my God, I have this tool. I can actually analyze it in real time. It takes me 10 minutes to update this. And then I'm looking at kind of the historical volatility of all the categories. And then I read this Bloomberg article about this birth-death adjustment, which I'm not sure if you know about, but I'm like, oh man, this is just another, what this reminds me of? It reminds me of all the CPI and the PCE stuff, where the closer you actually get to these, you start studying the methodology of all of them, and you're like, okay, this was a survey. This started off as a pure survey of something that is related to whatever this number is. And then we adjusted this, adjusted that, put this estimate on top, another estimate on top, threw it into a blender, blended it all up, and then poured it out for us to drink. And today that drink tastes terrible. But I really can't necessarily tell you what it is. This birth-death adjustment, Bloomberg called it, right? They're like, payroll is going to be above 200,000 and unemployment is going to go up. And it's all because of this. And so I immediately went to the BLS website and started reading about it. And I can tell you, I'm not smart enough to understand it. So I'm like, all right, what I want to give them the benefit of the doubt though with this, right? These adjustments, I think, this is by my views, right? Not Bank Creek's necessarily. I think that they really do help with the long-term kind of smoothing and long-term analysis of these types of data sets. Same with CPI, right? But the problem is not necessarily that we're doing these adjustments, or they have economists that are, cooking up all these different sort of adjustments. The problem is that and it's just the frantic markets, right? We latch on to that latest data point, and we don't necessarily, and it moves and FX goes up or down or whatever happens. And I'm not sure if that's the intention. If you actually got I'd love for you to get someone from the BLS on here and be like, hey, look, do these adjustments really help us with very long-term trends, or are you trying to nail this number on a month-to-month basis? Because everyone in the market is looking at this as a month-to-month driver. And so the number comes in at 270, whereas if you look at what Bloomberg said, they're the real number is more like 100. I have no idea. Again, I'm just the data nerd, so I can take this data and then deconstruct it from there. So let's put this birth death thing aside, because I've already told you more than I know about it. But read that article from Bloomberg, by the way. When you really drill into the data and look at the longer term kind of trends, what starts to pop out, and hopefully what our visualization will really smack people in the face with, is what is going on in healthcare. So you have healthcare, and this is one of the reasons why when you go to that visualization and you hover over any one of the boxes, you'll see a long-term trend chart. And just pull up, I mean, I challenge you, pull up any of the healthcare industries and then take that and slap the Fed's rates on it going back to 1990 and just look if there's any correlation there at all. I mean, like, that's what it looks like, right? Accelerating into this rate increase. And so it really makes you wonder what's going on there. Because if you look at any other of the segments, you know, we're looking at absolute numbers here, right? What you have up on the screen. But you'll see those, and you'll see the bumps, the ups and downs and ups and downs. And honestly, one of the reasons I'm so excited about this visualization is because it's an entire history lesson embedded within visualization that I hope also will help people that are looking for just the deconstruction of the latest number. But I mean, look at the ups and downs and the cycles and so on and so forth. I can't tell you that's all driven by rates, but it certainly is driven by macro events, right? And then you got healthcare, right? And so
just to say for audience who's listening, so if we hover over a boxes of, so first of all, the size of every box is how large the contributor was to jobs for the month of May, the 1 month over 1 month. And so we're looking at manufacturing, which, you know, only added is this 8,000 jobs or 8,000 jobs? Yeah, 8,000 jobs. It is, well, number one, kind of a secular decline, that manufacturing is, you know, fewer people now work in manufacturing than they did in the 1930s, but it's cyclical. And I guess let's also look at construction. So this is very cyclical. You're seeing some peaks and valleys. Yes, trend line goes up over time, but it went down in 2008. It went down in 2000 recession, the mid 1990s, 1980s. I'm just ballpark. This matches up when there's a recession, construction employment declines, and the Federal Reserve cuts rates. Whereas now we're looking at private education and health services, and this just looks like the chart of Berkshire Hathaway stock over time. It is a secular grower, and the only time it ever declined was in 2020. But
it looks like atmospheric carbon dioxide. That's what.
Yeah.
Straight up and to the right. Besides COVID, of course.
Exactly. So your point is that this is a secular grower, and this growth in the labor market will not be less sensitive to the business cycle, to macroeconomics, and to the Federal Reserve. Yes?
Yeah, exactly. And before I tell you about why I have so much conviction in that, if you go back to that visualization, one of the problems that I had, and when we were developing this, another guy on my team, he's like, what do private education and health services have in common? Like, who came up with that? Like, why would they merge them together? Well, I can tell you, I have a junior in college, he's going to be a senior, or I'm sorry, a junior in high school, about to be a senior. And I can tell you probably, I think I finally have figured out, not like this was the intention of people that developed this years and years ago and put these two things together, but I finally figured out the commonality between private education and health services is they're both based on fake, artificially inflated prices with random arbitrary rebates. And so, I mean, that's my experience now kind of looking at colleges. You have to do these net price calculators and everything. And that for sure was the experience that I had when I was like studying the prescription drug supply chain in, you know, way too much detail for pretty much the better part of 5 years before I joined Bain Creek. But before we go there, because I want to go there, go and change the display level to 3. Think of this as kind of like, you know, we're getting on the top level 0 of like a mine, and then we're just going down into this murky, darker mine shaft, right? And so level 2 is the level that you're going to see in the reports from BLS. Like if you go and you look at the employment situation report today, you'll see all the level 2. You'll see some of level 3. Well, what people don't necessarily know is that this goes all the way down to level 7. Now, there is a lag in reporting. So what you'll see is that, you know, you'll get everything for level 3, most of the stuff for level 4. But then as you get down to level 5, 6, 7, the stuff for May will just drop off. It will fall off. They don't report it. So you have to really go back to April in order to see that. So it's reported 1 month in arrears. But what I wanted to point you to was see how healthcare and social assistance is driving all of this. Like private educational services is largely plateaued. It's back to its COVID peaks, whatever. If you go back to April, so you can just go to the choose base period drop down, switch that to April. So this number was revised. It was revised down to like 165,000. 100,000 of that was healthcare and social assistance. So like this is the 800-pound gorilla within our jobs data at this point in time.
So it's all healthcare. So there's this broad brush called healthcare and private education. You're zooming in and saying, I mean, just it looks like 80 to 90% of this is actually healthcare and social assistance rather than private education. So this category is called healthcare and education, but really it's mostly healthcare.
Yeah, then keep drilling. I mean, go down to level 4. I'd stay on April for now, just because you.
All right, level 4. We're going to level 4.
And now you see the true value of a tree map. So let me just take a little bit of time. A tree map is basically showing you the hierarchy of the data as well. So everything over to the left is the private education and healthcare, whatever they call it, super sector. So when you drill down to this level 4, I think you can really see the benefit of what's called a tree map, which is a data visualization technique that is really appropriate for complex hierarchical databases, which is exactly a perfect description of this database. So what you'll see is you'll see a group of these boxes, which are, and you're hovering over right now. So you can see it says private education and health services. That's what's called the super sector. And then social assistance, ambulatory healthcare services, hospitals, nursing, residential care. Those are all industries at the level 4 of this mine shaft that we're working our way down right within that. Then you'll see these kind of thicker white bars that are separating that super sector from the other super sectors over the right. So if you go over to the right and hover over general merchandise retailers, that's retail trade. And here are all the ones that are the industries that are driving things within retail trade, and then so on and so forth. And it only gets more interesting as you go down. Like if you go down to level 5 and 6, there's like almost 300 industries in level 6. And so you can see all these tiny little slivers of things, which I mean, I'm actually, so I haven't put out the, while I've published this on the website, I haven't put out like the how-to report yet. And so I like using a lot of humor in my reports because one thing I'm not good at is being brief. Levity is my strong suit. And so I use humor to kind of keep people engaged. You figured that out by now? I went down to level 6 and I was like, this is what I plan on writing. I was like, I wanted to find the needle in order to find the needle in the haystack. And so I literally just started typing needle, like the keyword needle into highlight industry. And there literally is an industry called sewing and needlework. And if you do that right now, it will basically just pop up and show you exactly which industry that is. And if, I don't know what people are going to do with this data, but I'm jazzed that you even can get a hold of it. So I'm sure that there'll be someone out there that's like, man, I just wish there were more.
There we go. Sewing needlework. Yep.
Not good, right? It's probably worth considering.
I had a feeling it was in decline. Yeah.
Secular decline. Yeah. Well, I mean, a lot of the retailing is.
Yeah. I would have thought that was kind of manufacturing.
Well, I mean, think about what Amazon's done, right? I mean,
right.
You're just seeing the flip side of that coin with the Amazoning of the, and what another cool thing that you're seeing is like one of the largest growth. And by the way, you can actually go and select the comparison period. So say you're like not interested in 1 month. You want to know how these things have changed over the last 5 years, 10 years, 15 years, 20 years. So you can change that. And if you look at pre-COVID to post-COVID, the number one growth industry has been warehousing and storage.
5 years. So trading 5 years or 3 years or what? 5 years.
5 years. 5 years just brings us back to pre-COVID, right? So if you look at general warehousing and storage, you see the dark green one that's down.
Oh,
at the
this one. Yeah.
The darker the green. Yeah.
Wow.
Look at that. You know what you can do with that chart? You can take Amazon's employees and you can overlay that on top of this. It almost goes down at the exact same time that Amazon started laying people off after rationalizing your network. It's fascinating, right? And so then you think about it and you're like, okay, well, let's say that's just like not a true causality there. But 5 years ago, how often were you able to get goods within something you ordered in an hour? And how do you think it happens? Is it magic, or is it just that there's a lot more warehousing and storage facilities that are much closer?
Those are working people. So that's the biggest increase. That's the biggest level 6 increase for that subsector, general warehousing and storage, which is part of transportation and warehousing. The second one is services for the elderly and persons with disabilities, which is part of private education and healthcare services. But interestingly enough, management consulting over the past 5 years increased by 336,000 people. That's a big increase in consultants.
Yeah. So I have less, like, I could probably talk more to the healthcare side with, but based on my experience, but like, here's my thinking on management consulting. And again, just my 2 cents for what they're worth. If you also look at, and this is really over the last 10 years and so on and so forth, coding, obviously, you'll see massive increase. Like all those people working at big tech companies, like they're basically falling into that. And into some, you may not see it over the last 5 years here, but there have been dramatic increases within software development, that kind of stuff. And then another thing that you'll see within this same, the professional business services is scientific and technical has had a very large increase as well. And so a lot of that is being driven by, Ozempic, how's that made? Like these are biologic drugs. And so a lot of that, which this is kind of where my background is, a lot of the shift from what were traditionally oral solids, like think of the capsules, the tablets, all that kind of stuff. Those are super easy to replicate, and so the life cycle of the drug is just, you don't make as much money as a drug manufacturer. Whereas when you move to like really complex biologics, they're very hard to replicate. And so the life cycle is longer. Like you basically have the effective patent or exclusivity longer for a drug like that. And so there's been this big kind of shift over to biologics and then a huge, huge growth that really started in like 2016, 2017. It was pretty flat for a while.
Management, scientific, and technical consulting services, or?
There we go. Yep.
Got it.
Computer systems design and related services as a 358,000 increase. We have scientific research and development. That's the one that really took off, which a lot of this is kind of the biologics drug development. So my take on the management consulting is, and this is a very kind of like overly simplistic, think about how management consulting, like where do they thrive? They thrive when there are big changes within industry. And like, how are you going to adapt to the change in AI? How are you going to adapt to the change from oral solids to biologics? These are big time changes that are, groundbreaking within industries. And so that's where management consulting comes in, is like, hey, we can help you.
Yeah.
And so that's my overly simplistic kind of, 30,000 foot view of like, why is management consulting going up as well? Because there's just a lot of change going on right now. I don't have to tell you that, everybody that looks at NVIDIA stock knows that.
Yeah.
So interestingly though, these have leveled off though. I mean, like that's kind of something to, I think, if leveling off is a good thing, great. We're all looking for moderation in jobs. Like it appears that whatever the Fed has done has actually had somewhat of an impact on the professional and business services. Like even these like super hot areas like AI, you're just not seeing them in the numbers yet. You're not seeing like another step change in growth that we saw kind of, coming out of COVID. That's not happening in healthcare. So healthcare is accelerating, at an even faster pace coming out of COVID. And that's where I really think the focus should be. And that's where I really think the story is, because everything else, like it seems to at least be somewhat macro sensitive, except healthcare. You had mentioned that services for the elderly and disabilities. Like I actually had to go to the industry lookup tool, which I've linked this on our website. So if you're interacting with the visualization through our website, there is a link to basically it's a census.gov site where you can look up the NAICS code. And so you can look at whatever that NAICS code is on our visualization, pull it out of that, and then go to that website, drop it in, and be like, what is services for the elderly? And it turns out it's like adult daycare centers, it's services for disabilities. It's stuff that like you just would not expect that to be. When I look back to the beginning of 1990, it's gone up like 1,000%. Since the beginning of 1990. It was an industry that did not exist at the beginning of 1990. Fun fact, one of the only things that has gone up faster at a higher percent rate than services for the elderly and disabled people?
Health and home care?
Mental health.
Mental health, okay.
Mental health practitioners, which, I mean, maybe that's a good thing because it's not as taboo to go go to therapy, or maybe it's a bad thing, saying that we need more of those services. But healthcare is just littering the upper echelon of that list. I mean, it's really, really transformed meaningfully.
Forward Guidance is brought to you by VanEck. The VanEck Morningstar-wide MOAT ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? MOAT strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/moatfg to learn more. That's vaneck.com/moatfg. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar-wide MOAT ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks, let's get back to the interview. I just want to say that I do a lot with data myself in terms of making charts. And I also look at a lot of other people's analysis of data and visualization of data. A lot of them are just, from a Bloomberg chart, they download the chart. This is next level. So I would be surprised if there is a publicly available employment visualization tool that is better than this. So good job.
That really, really means a lot. I mean, like I said, this whole Inception analogy that I gave you, like, I really do view this as art, because when you are looking at a database, you're like, what's the story? What's the story here? And then the answer is like, depending on the user, like many of the people that are listening right now, they may be like, the story is 272,000. And I want to be able to help people that are interested in that story, the month-over-month story. But then other people, healthcare policy workers or whatever it may be, or just people that are generally interested in the history and how this economy has changed, there may be a different story. And so taking that and then figuring out, like, how do I create one visual that can help address all of these stories that will not hide the data and not basically impart my own biases on it, because it's the last thing that I want to do, and really help communicate this to people that want to use it in different ways is a really, really challenging endeavor. It was much easier with inflation, honestly, because I frankly didn't care what people thought. I was like, look, man, I just want to know if this number is 3.5, I want to know what adds up to that. That's all I want to know, right? That's pretty simple. It seems like that's all that matters. And so that one the story told itself to me. But with this, I really struggle, trying to figure out, how do I capture all of this, not lose people, not shy away from the details, but then also give something that people will use that's helpful. And to hear that from you, it really means a lot to me, because, I've worked pretty hard on it.
I can tell. What are some other broad conclusions that you have drawn from analyzing data? One is healthcare is a secular grower and so far has been much less sensitive to interest rate hikes and a cyclical slowdown that has occurred in other parts of the economy, not necessarily to recessionary levels, but to just growing less fast. Healthcare, that has not occurred. What else have you observed?
We already talked about the warehousing storage. We talked about the professional business services. When I looked at, I initially started off wanting to understand, how did the economy change, pre-COVID to post-COVID, because stuff got accelerated so fast, and I think the number was something like 75% of all jobs came from healthcare, this professional business services, largely driven by some of the industries we already talked about, and this general warehousing and storage. And, when we were just looking, if we had kind of a more, recency bias around the numbers, we would look at, leisure and hospitality. And you looked at those massive job gaining numbers kind of going back a year ago and so on and so forth, where they're just adding hundreds of thousands of jobs a month. And then you're like, oh my gosh, when is this ever going to slow down? But I think what this tool helps you do is put that in perspective, that it's really just getting back to where it was pre-COVID. Maybe it's a little bit higher now, but overall that really hasn't been like a major change from kind of where we were pre-COVID to where we were after COVID. So people there are don't have much better job opportunities now than they did before, even though that was a huge driver of all the job growth over say 2022 and everything. The other thing is that this year, government job growth has been really a huge driver of these numbers. I think one of the cool things that I just learned using the tool is that if you go down from level 2, where it's just government, to level 3, it breaks it out into state government, local government. A lot of the job growth is coming from local government. And then what I like to do is I like to pivot it, kind of going back, okay, here's 1 month, here's 1 year, here's 2 years, 3 years, 5 years. if you actually look at it over a 10-year trend line, like there really has not been much job growth in government from what I remember using the tool. I looked at it and, there are far more jobs in local government, as you would expect, than there are in state and federal. So even though the absolute jobs are increasing the fastest in local, if you look at it on a percentage basis, it's actually state government that's increasing the fastest. And federal is kind of somewhere in between the two. So that's been another interesting takeaway. I think hopefully this tool will help people kind of like move away from the recency bias to be like, oh, actually there hasn't been a lot of government job ads over like a very long period of time. Whereas like, maybe we should look at this healthcare situation a little bit more deeply because like, I don't have to, and I hope we get into this, but like, this is driven by very unique structural design of how these companies make money. And there's no kind of forecast for that changing outside of massive regulation. And so the best forecast for it is for it to kind of continue to just march to the beat of the same drummer. And, when you look at 1990, I think the healthcare and social assistance, which you're looking at right now, that level 3, it was 8% of all jobs. It's now 14% of all jobs. It's grown at a clip of 126%. If you exclude that from non-farm, that's grown at a clip of like 30-something%. And so this has outgrown the economy by 4x. And so at some point in time, if we just for argument's sake say, okay, macro, this is immune to macro movements, maybe this is the cycle where it breaks the metric, maybe it's next cycle, maybe it's a cycle after that. But at what point in time, and this is what my initial interest was, is like, at what point in time does the Fed no longer have control over this metric? At least on the margin. I'm not talking about like jobs are terrible or jobs are great and we need to like move this in wide swaths. Like I'm talking about the fine tuning that happens right now. Like you can make an argument that we are approaching the level of healthcare intensity within our economy is approaching the level where we could start to lose control of this. If we keep adding 80, 100,000 jobs every single month at the same clip, it's only a matter of time before this thing eats up the economy and the job growth becomes most of the job growth. And so that's a concerning thing for me, because I think everybody's looking at these metrics as kind of a result of this one kind of giant knob that, the powers that be have. And I think we're seeing this. This is not kind of like an out of consensus view that we're seeing this on the inflation side. Like, does that knob really work anymore? Like, I'm not so sure. Like, it certainly works if we need to go from 8% down or 0% up when it comes to inflation. But does it work going from 3.5 to 2.5? I mean, we have like this OER stuff, like owner's equivalent rents of residences, weird survey methodology, what's going on with auto insurance. I mean, we got all these random things that we're like, does the Fed really have control over that? Do we just have to wait longer? Is that what we're being told? People are saying that, right? That's not kind of an out of consensus view. Where I'm coming, that may be a little bit more new, is that I kind of think the same thing's happening on the labor side. Or I think it may be early, maybe I'm 5 years too early, but it will at some point in time, if we don't make very large changes to how healthcare is delivered in this country, will eventually, I think, break the linkage between the Fed's fine-tuning of labor within this economy and that metric. And then maybe we'll just adjust the metric and say, well, now we're looking at labor X medical care, and then everybody will be happy. We'll have a new core labor measure that doesn't include healthcare.
So long-term, that can be bad if the U.S. healthcare system is very inefficient as it is. So you keep more and more people have to enter that healthcare sector, and the Federal Reserve can't control that. I could see how that could be a bad thing. But short-term, if you want to avoid a recession, it sounds like healthcare is just going to keep hiring and hiring and hiring, and that could, as it appears to, as it has over the past few years, blunt the Fed's tools of causing a recession.
Correct. And it will only get more powerful as time goes along. And I think it's because, and we can get into this if you want to go into my background, but healthcare in this country is a system of opacity. Pricing is unknown. It's highly inflated, and then there are hidden rebates on the back end. And the pricing is variable, right? So, for example, like let's just talk about on the drug side of it. The pharmacy benefit managers that are administering and, responsible for basically your employer's pharmacy benefits, they may have 1,000 different pricing lists for the same exact set of drugs. So that's basically like going into the grocery store and saying, oh, there's all this crap on the shelf, right? You know, here's the box of Cheerios and this and that. Depending on who you are and what time you walk into the store, take the price off of those things and then make it one of those kind of like digital pricing things, and then flip. It just flips from one to the next. One moment it's $1, the next moment it's $70, the next moment it's 50 cents, the next moment it's $100. And I'm not exaggerating with like the numbers that I chose there. Like boxes of cereal in the healthcare world, or at least in the drug world, and I'm talking about cheap generic drugs, could be marked up by 10,000%. It's very, very common. And then there are these discounts that are negotiated behind closed doors that are locked into contracts with a pharmacy and contracts with the employer, and neither side can talk to each other. And so what you have, and this hopefully will resonate with your audience, especially on the drug pricing side, you have a system of arbitrage. But in the markets, all the pricing is transparent with arbitrage. So if you have like, you know, I'm going to assemble synthetically a basket of, you know, these equities, and then it should match that, and it doesn't match the overall index, I can go ahead and do that. And then boom, I've corrected that arbitrage. Well, imagine for a moment that you control the prices though. So like I, the one that's making the trade on that arbitrage, actually control the buying and selling price. And I'm hiding that price from the buyer and the seller. That's how it works. It's exactly how it works. And that's a system that can generate its own profit. And so, I mean, look, like that, I know the PBM industry very, very well. And so I've seen this. I've like literally matched up individual claims between pharmacies and between payers. And by that, I mean an employer, and you'll see like a pharmacy got $20 and the employer paid $2,000. Like it's very, very common practice. That, in essence, that level of opacity, while it may not be that kind of crazy, and there may not be this level of like pure just like trading arbitrage that's going on outside of that, it's similar in hospital, right? I mean, like go and pull up a charge master, like look up your local hospital and pull up what's called a charge master file, and you will see the list prices on all of these procedures. And you'll be like, what is this, like monopoly money? I mean, like, you know, they're ridiculous numbers, but they start to make sense when you realize that every single player throughout the supply chain is incentivized, basically makes money off of higher list prices. Insurance companies, they're making a percentage of list price. PBMs, a percentage of list price. In some cases, pharmacies, percentage of list price. Governments get rebates based on a percentage of list price.
But Eric, don't insurance companies have to pay? Aren't they basically short the cost of the procedure? Because if, you know, you get
only in that individual year. But think about it, a longer term, they're just going to go back and like I used to run a business with 200 and something employees. And so in that individual year, yes, they have the incentive to actually drive the prices down. But if they do that in each individual year, they can't come back to you the next year. And everybody who's listening who runs a business will know this because it's very painful, and say your premiums just went up by 30%. And that's where the real game is. It's about the increase in premiums over time. That's where everybody's making the money. Even the healthcare brokers that are supposed to be helping you through this process of how do I even select the right, they're making a percentage of the list price. And so you look across the entire supply chain and you're like, how did we get here? Everyone that is responsible, except the patient, for delivering services to the patient benefits from higher cost on charge masters, benefits from higher list prices. I mean, there's a reason why I compared back in a prior life, I compared the list price of the average brand name drug, and these are the drugs that are on patent, in the US versus the list price in Australia. And in Australia, it was 20% of the price. And that's totally common. I mean, like if you look at Australia, if you look at Denmark, if you look at the UK, if you look at any other developed country, which has made a very, very different decision than we have in this country, right? They have made a decision, and this is ultimately how I think it's this simple. Healthcare is a human right. Then secondly, a business. We have made the decision with healthcare, which is driving the, quote, strength in our economy. Healthcare is a business first. And then hopefully they'll figure out a way to deliver all this accessibility and, you know, make it cheap enough or whatever. But first and foremost, it's a business. And we're really the only developed country that has made that decision. I do have to say there are benefits to that. Like, look at where all of the drug innovation is happening. It's this country. And frankly, if there wasn't so much money available, we wouldn't be getting, treatments for rare diseases. We wouldn't have hope on Alzheimer's drugs. Like, we wouldn't have hope on people from other countries don't have access to those drugs. They just don't, And the only reason, again, that they even exist is because we're funding it. And so we have a system that is very good at being highly inefficient when it comes to delivering healthcare services and massively overpays and massively overemploys, but is the engine of global innovation for healthcare. I mean, where are the best hospitals in the world? You have a rare procedure, you're going to Mayo Clinic, you're going to, Cleveland Clinic, you're flying from wherever you are in the rest of the world. And if you have the money to do it, you're coming here. So I think that I was much more naive maybe 3-4 years ago. And I was like, this is bad, this is good. It's not that. It's just that we have a system that's designed to innovate. We do not have a system that's designed to be efficient. It's designed to be horribly inefficient and drive way more money than is necessary to companies that then will reinvest that and come out with some very innovative products and other products that we don't need, right, at all. There's something in the drug world called line extensions. Sorry to go so deep here, but literally you can take two old, ancient generic drugs that are each like pennies per pill. You take them, you combine them together into one pill, and then you can bring that to the market as a new brand name drug and charge hundreds of dollars per pill for that. And then you can go to the PBM and say, hey, look, I know this drug is garbage, but you know what? I'll give you a huge rebate if you actually put this on your formulary and get it in the hands of all these people. And they're like, great, we like rebates because we get to keep a portion of those. And so then they'll add that to the formulary. And then all of a sudden, boom, it's now in the American marketplace. You know what happens in other countries? They look at that drug and they're like, that's the stupidest thing ever. Like the country itself is managing what drugs can get dispensed to their population. And they're like, well, if these two drugs are 5 cents each, why wouldn't we just issue 2 prescriptions, for this rather than this one drug that's combined? So this is the reason why I'm kind of, screaming from the rooftops right now that like, there is a reason why these charts look like the atmospheric carbon charts and just keep going up. Just like we all know the reason why that's going up. At this stage, like, I don't think it's me coming, with my crystal ball, like trying to make a prediction. I think it's just understanding the inner workings of how healthcare delivery works and how the money flows within this country that leads you to believe that, like, look, there could be some bumps in the road. It could come down and everybody will celebrate and everybody will be like, and the Fed will cut and whatever. But this thing is just going to keep marching along and become a larger and larger and larger part of the economy.
So the rest of the world is in some regard free riding off of the innovation that occurs in the US that only occurs because we have a super inefficient process. Eric, where is the inefficiency in the healthcare system? I probably would guess it's not the nurses or the doctors. Is it on the administrative side?
Yeah. So, I mean, I just did this analysis the other day and, prescription drug expenses within this country since the beginning of 1990 have gone up by over 1,200%. The entities whose job it is to ultimately control that, if the incentives were right within the system, are the pharmacy benefit managers and the drug manufacturers. Pharmacy benefit manager employment has gone up, employees have gone up, and this is all in the data set. You can look at it. I think it's on level 6 or 7. They've gone up by 126%. That's the administrators, the middlemen, right? The drug manufacturers have gone up by 60-something%. The retail pharmacy employees have gone up by 15% over the same period of time. And if you look at it since the beginning of 2000, they're down. So we actually have less people like face-to-face, like interacting directly with patients than we do, despite the fact that we have like an over 1,000% increase in prescription drug costs. So, and you could also, like, I'm not as much of an expert on the hospital side, but I have a lot of friends in the hospital world. And we expanded Medicare Part D in 2006, then the Affordable Care Act came in, and then Medicaid expansion, and so on and so forth. And with all of these government programs came more and more and more and more metrics. And so if you actually talk to somebody who's working in a hospital, there's just like dozens and dozens, a series of metrics that they're held to by these government organizations, which, ultimately their reimbursements are going to be dictated by that, then they have to actually hire administrators to kind of keep track of all these metrics, make sure they're on track with the metrics, and hire consultants to figure out how do you game the metrics. Not like I'm saying people are gaming it, but any metric can be gamed if you want to. And so, you have a swelling in the complexity. This is what it is. It's just like the healthcare system in now compared to 1990 is vastly more complex, but there's no more transparency on it, right? And so within that complexity has become the opportunity for new consulting opportunities, for just new business opportunities as middlemen, like not physicians that are directly interacting with patients, not pharmacists that are directly interacting with patients, for everyone in the middle of the call it healthcare complex that is part of, delivering the services and ultimately taking a piece of the pie. So I think that's where, at least in the data, you see the swelling. And that also jives with kind of my studying of the space.
So, Eric, I also want to just return to the point you made about the growth in government spending. Yes, a lot of the job growth of the past few years has been in the government, but as you noted, a lot of it is in the local government, which is interesting. And what you said is correct. If you look at the charts of the growth in federal government employment has gone up over the past 3 years, but it's been stagnant for a long time. And actually, the total level was higher in 1990, in the mid 1960s, and even in 1945. I imagine that the Army was probably involved in. They were employees of the federal government. But the growth in the deficit cannot be attributed over the long term to growth in government employment, I would say.
Yeah. No, the data totally shows that.
It's spending on programs, it's sending people money, and it's cutting taxes probably.
Yeah. So when I'm saying government spending, I mean, government programs like the ballooning of Medicare, the ballooning of Medicaid, like staying on the healthcare side of things. And then what Medicaid has done as well. And so just briefly to explain Medicaid, like super high level, Medicare, elderly people, 65 and older, generally speaking. Medicaid, very, very low income. And where basically there's nothing that you have to pay out of pocket if you're a patient there. And what happened is as Medicaid expanded, state government employees weren't expanding at the right rate to administer these programs. And so what they did is there's this entire industry that ballooned called managed care. And that basically just means that I, as a state, I'm like, oh my gosh, I have this huge program that I have to administer. Let me just fix my cost and go to an insurance company. They can administer this entire thing for me. So like Centene is an example of a company that does this, right? And so I'm going to go to managed care, outsource this to them, sign a contract with them. But then what happened is that Centene, or the managed care companies, they signed a subcontract with the pharmacy benefit management companies, which over time they merged together. And so you also have this huge problem of vertical integration within the space. So like Aetna and CVS, like that was an issue, and I'm saying, again, this is my own personal opinion, but when you have the government is reliant on Aetna and then wants a third-party agreement with CVS Caremark, but now they're owned by the same company. And by the way, the government had no view, and I saw this directly, the government had no view into the contracts of the subcontractor. And so there was all sorts of shady stuff that was actually going on there, like, money that was being shifted around and stuff. And again, nothing illegal. This was all just, brilliant minds within these companies that are like, how do we grow shareholder value? And look at all of these knobs we can turn. Like, so going back to the Fed, they got one knob. If you're within a pharmaceutical benefit manager with an insurance company, you have hundreds and hundreds of knobs that you can dial up or down in order to, increase or decrease your profit. So it's easier to make money in Medicaid on one part of the supply chain, and that part, like the pharmacy benefit manager side, but it's harder to make that money on Medicare on that side. And so you have to shift it over and make the money on the insurance side of it. And so once they're all vertically integrated, well, now all bets are off on what's going on. So government expenses are going up, but government doesn't have employees to like watch over everything that's going on, right? As you can see within the data. And so they're sending this off to private, entities, managed care, pharmacy benefit managers, so on and so forth, who are then just doing whatever anyone with these incentives would do. They're trying to figure out, how do I use this program in order to make the most money out of it, and then throw Medicaid expansion on top of that, and the problem just exacerbated, And the good news is that I think, there's been a lot of advocacy and transparency around this recently about how bad it got. And so some of those things are starting to unwind. Like New York recently just said, we're taking this program in-house. But then, state government employees have to go up in order to administer this. But ultimately, it should save money for the state in the long run. You're just not going to see that within the labor data. You have to put all the pieces together within that.
What are the industries that are shedding jobs the most rapidly? And yeah, on the negative side, what are you seeing?
Yeah, so the cool thing about this viz is just go up there, and I don't know what time period you want to look over, but let's look 5 years. Just look at what is the most red, because the color red, deep red, means largest drop absolute in jobs. It's not percentage based.
Mining, quarry, and oil and gas extraction.
And so right now, I just happen to be looking at April 2024 5-year comparison period, display level 5, and I see clothing and clothing accessory retailers, which just died, during COVID, and then really hasn't come back. I see business support services, which has come down a lot. If you drill down into that, you'll see it's temporary help services, which are declining a lot. Interestingly on there, it's skilled nursing homes or still skilled nursing care facilities, which is down a lot. It's the general theme to me is that oil and gas has come down quite a bit. And this shouldn't be a surprise for people that pay attention to the industry. They all got whacked during COVID when oil prices turned negative. Everybody, this industry, for as long as I can ever remember it, and I worked in this, that's how I got my start. This industry is just ruthless, competitive supply demand, right? Prices are good. Let's drill as much as we can, get as much oil out of the ground. We crater prices, just back and forth, back and forth, back and forth. That all stopped after COVID. And you can actually see that in the data. I don't know exactly what display level it is, but hopefully people will search for it. And they'll find oil and gas drilling activities, and you'll see that it really has not come back much.
Lower than 1980. And also, I think it's gotten a lot more efficient.
For sure, the production per rig is down a lot, but it's not down a lot since 2021. The efficiency hasn't step change improved since before COVID. It's step change improved since 2008. But I'd say that the major driver in why that's declined so much is simply the discipline. Everybody is kind of signaled to each other that look, let's focus on margin. Interestingly enough, and this kind of, I don't know if you want to transition over at some point and talk about CPI or whatever, but interestingly enough, another one, and I think this is down on level 6 or maybe even level 7, is new home construction. And when you actually go and drill down to that level, you can see that, you're not, by the way, you're not going to see it in May. You got to go to April because May doesn't have all of the granular data. Again, that's 1 month in arrears.
Okay.
Yeah. So if you go back 1 month, then you'll see all of the nitty gritty detail. It's either on level 6 or 7. But if you look at new home or new residential construction or whatever, that has not recovered to 2008 levels, not even close. And so
should I do 5-year or 7?
If you look at display level 7, what I would do is go down to the highlight industry and start typing the keyword in. So I just typed new in there, NEW. And there it is. New single family housing construction, except for sale builders. So you look at that and you're like, huh. I just saw this morning and I was like, is the same thing going on in this industry? I don't know much about this industry, but is the same thing going on here that's going on with oil producers where we would just make much more money if we focused on margin over just hammering out homes, and then creating this, but the jobs have not come back. And maybe they've got more efficient.
Sorry, there's 3 categories. There's new housing for sale builders. There's new multifamily housing construction, excluding for sale builders, and then new single family housing construction, excluding for sale builders. Isn't every home builder a for sale builder?
Well, that's actually a really good point. So go. You know how we can tell? Go to the hover over that again. So there's 600,000 employees at the peak. Now go down to the other one.
Yeah.
Go to the other one. That is 50,000. So no.
Oh, wow. Yeah.
No, this is far smaller than that. So look, at the end of the day, and this is another kind of so by the way, stay here for a second. If you look at that pop-up and you see the NAICS code, NICS code 236115, it's really important. I don't have the lookup connected yet, but if you go to our website and scroll up, you can click on a link that will take you over to the census.gov website, and you can hammer that or just type that right in, and it will tell you exactly what it is. So that to me is one of the most helpful kind of like little hidden Easter egg gems within this thing, is because like you could be looking at this and have the exact same discussion that we just had and be like, well, isn't this? That census.gov lookup table will tell you exactly what this industry is. I mean, to the best of the ability of the internet, right? So I've done that many, many times where I'm like, I really have no idea what this means. And you flip over to that table, and that's where you can really get some insight on that. Eventually, I want to link that database into this so it comes right up in the tool. You don't have to leave the tool, but I'm not there yet.
Yeah, there's two pieces of industries that have lost jobs and are continuing to lose jobs month by month: business support services and employment services. Both are part of the macro sector, the super sector, professional and business services. But to what, I have no idea, and it's okay if you don't know, but what are business support services and what are employment services?
Well, I don't know the answer to that off the top of my head, but what I would do to research that, and we can do it live right now if you want, is I would take that NAICS code 5614. I would open up a new window, go over to the census.gov website, and type in 5614, and it will tell you exactly what it is.
Okay, so it's document preparation services, telephone call centers, telephone answering services, telemarketing bureaus, and business service centers. So it's telemarketing kind of. And that makes sense. That industry is being automated. There's a lot of automation going on there.
Yeah, and one thing that it's a little bit harder to see, because I did want to show you the absolute change, but some percentage changes are just absolutely dramatic. Like if you go and you try to find newspaper publishing, like any of that kind of stuff.
Oh my God, yeah.
They've gone away, right? And so that you won't see that right off the bat. But what I'm really hoping people do is they say, all right, I'm going to spend the next 10 minutes just kind of like hovering, and like just seeing what's interesting, because it really is an education in how much the economy has changed over the past 30 years.
That is what business support services is telemarketing and phone calls. And then the other one, employment services, that is temporary help services and professional employer organizations. So that's people trying to help other people find a job, I guess. And I guess with LinkedIn and all sorts of Indeed.com, that makes sense that also is an industry whose employment is contracting. All right, Eric, we've done a deep dive. People have got to check that out if they're, if they are professionally doing this and they want to get an edge, or if they're just, a geek and they're really interested in it, like I am, they got to check that out. Now let's go to your inflation CPI versus PCE calculator. And by the way, Eric, this is how we first got in touch. You have been down to the wire doing this work on the employment, but your original work was on CPI versus PCE. So we'll switch and go over to that tack. But yeah, what are your broad findings there?
Let's start with CPI. So CPIU, that's what's published at the start of the month. This could come out next week. The reason why and this was the first visualization that I put together for public consumption. The reason why I put that together is because when I was poking around in the data, I was like, oh my gosh, like OER, owner's equivalent rent of residences. So just kind of like to double click on that just for a second. That's a survey that the government conducts where every 6 months they pick you, Jack, and they call you up and they say how much, like literally, I think this is word for word almost, or I'm paraphrasing, but how much could you rent your house out for right now? If you could, like hypothetically speaking, how much could you rent your house out for? So that's the survey. That's what it is. There are all a bunch of adjustments and everything they put into a blender. Out pops the number, right? Or out they pour the number. So that single line item is a roughly 25% weight of all of CPI, which I wanted that to come across viscerally to people. Like, look, like at this stage, CPIU is 3.36, but hover over that, and out of the 3.36, I have this category that I made up called inflation impact. It's 1.463 of that. So if you take all of the inflation impacts on this chart, you add them all up, you're going to get a number that's pretty close to the 3.36. It's not perfect because the data is not perfect. But that's basically telling you that that one category is responsible for 43.6 of all inflation. And so I actually think that CPI is like super straightforward to analyze right now. Like, I mean, I spend almost no time each month. And people ask me, like, what are you looking for in the next print? I'm like, big bubbles. That's all I'm looking for. Look at my tool. And so you have OER, you have rent, which OER and rent trend almost perfectly together if you look back at them, and motor vehicle insurance. So if you hover over motor vehicle insurance, this is like a really wild thing that's going on right now. So when you hover over something in this dashboard, you will see standard deviation bands. And the reason why I did that is because I want, people could get really kind of excited one way or another about a month-over-month change or a year-over-year change in one category. But there are some categories that are naturally highly volatile. And if none of us have a crystal ball and can't forecast any of these, then it's my view that we should look at like a number that comes in, say, maybe a little bit higher than you think. But if it's within plus or minus one standard deviation, I'm like, I don't know. That pretty much is noise, unless there's some like really nice trend that's forming and everything. So you have motor vehicle insurance that's a 3+ standard deviations above the mean right now. And so there is something wild going on here. And everybody knows it, right? I mean, everybody's pointing to it.
Right. So motor vehicle insurance, April 2024 relative to 2023, so year over year, YOY, is up 22.6%. Even though it's only 2.6% of CPI, it has contributed 58 basis points, 59 basis points of the CPI. So it is responsible for 18% of the CPI inflation, even though it's only 2.6%. And I think, anecdotally, what I've read, driving fell off a cliff during 2020, so premiums went down. But then, and the prices of car went up, so the business changed. But now they're raising prices. Progressive, this is Progressive. This is Geico, owned by Berkshire Hathaway. Those types of companies, they're raising prices aggressively.
That all makes sense, and I agree with you. That probably is the best explanation for what's happening. But I wrote a report on this, which is free to the public on the website. Like, I took this and I compared that metric to PCE's version. It's actually called net motor vehicle insurance and something else, but it's their version of and that's on my PCE tool. You'll be able to see it there as well. And it's a totally different story. It's like a 7% year-over-year increase. And by the way, they trended together with one another very, very closely, really through I can't remember off the top of my head, but it's in the tool, like through 2016, 2017, 2018. They trended very closely. Then they blew apart. Coming out of COVID, the two benchmarks just went polar opposite directions, And so the natural thing that I wanted to do, and I wrote all about this, is I'm like, okay, well, let me dig into the methodology document. Like, unless you literally want to, unless you enjoy hammering your head against the wall, like, I don't recommend doing this. But like, we're going to have to crowdsource and go to this eventually. But I started reading these methodology documents, and they don't say that within a level of specificity. Like, there is almost no perceptible difference beyond like real nuances within how they're measuring these, but they're both based on either real policies or surveyed policies. Some of them are every 6 months, some of them every 1 month, but it doesn't particularly say like, well, one of them is netting out the cost of repairing these vehicles or whatever. It's not clean. So I haven't been willing to actually say, this is exactly what the difference between these two things are. And then especially, I'm hesitant to say that simply because, it wasn't there pre-COVID. By the way, I think this is really cool that you can't even find it.
Yeah.
So that means that it is not driving. It's not meaningful for PCE. It's not driving PCE. It's only driving CPI.
So for our audience, one of the biggest circles contributing to CPI, I could instantly find it, was car insurance. I am struggling to find car insurance in this. So what is the difference? Yeah. I'm not going to check out the methodology, but what is the difference and why? I'll continue to look for it. Why? I mean, literally, beef and veal PCE. Beef and veal appears to be a bigger percentage, contributing bigger to PCE than car insurance. But why is car insurance so hard to find? Why is it so small?
Well, because one, it's about I think it was like, rather than a 2.5% weight of CPI, I want to say it's like 60 basis point weight, and so the weight is much lower. And then also the percent inflation is like 7% or something like that. So it's towards the bottom of here if you're just going to keep going.
God, reporting media is.
Oh, that's wild, isn't it? That thing is kind of scary. What's going on there? I mean, But that's the fun thing about this visualization is I always am like, what are these crazy outliers? You know, you're in the, you know, this feel like, what is that game?
Oh, there we go. There we go. Net motor, vehicle, and other transportation services.
Yeah. So prior year weight is 0.56%. So this is kind of getting to, you know, recently I got a chance to work with Financial Times on a piece. And, you know, my quote to them was like, there are 330 million different perspectives on inflation in this country. Why? Not because these numbers, I mean, you could talk about the measurements or whatever, but everybody has a different basket. Everybody has a different set of weights. And at the end of the day, now that I've been so deep in the weeds, I just look at PCE and CPI as like two different sets of weights. And you can throw like the euro area on top of that. I just looked at that yesterday and I was like, they have a totally different set of weights. I was quite frankly interested in their comments yesterday, or at least secondhand, I read it, that they're like, we feel pretty comfortable about our forecast going forward to cut. And then I looked at the weights and I'm like, well, no wonder. I mean, housing is like almost insignificant. I think it's 5%. Like the shelter component of housing for them is 5%. It's 25% just for OER for us. It's like north of 30% if you include rents here. You know, our hospitals is 1%, I think less than 1% there in the euro area. It's 7% of PCE, so 7 times the weight. Of course it's easier. It's like mostly
is it just energy, and what is it? I don't mean.
It's a lot of food. Food is a much higher weight. And like that's honestly, if you think about the methodology that you need, it's probably one of the easiest things to actually measure and one of probably the most accurate measurements that you don't have to make all sorts of these random arbitrary adjustments to. And so I'm like, okay, yeah, like that actually makes sense why they can cut, but why we don't have the visibility to look forward, simply because it's just a totally different set of weights. Now, I've listened to your prior podcast, which are all fantastic. Obviously, there are very big differences in the housing markets as well. I'm not going to go into that. I'm not an expert. I would encourage your listeners to go back and listen to all your prior podcasts to brush up on that. But we're just talking about the weights. Even if the numbers were the same, we would be in a very, very different position. I just want to touch on the auto insurance piece. Like, I have been screaming from the rooftops on this. Like 60 basis points of CPIU is auto insurance. Take just this, you can just literally do this. If there was no inflation in auto insurance, you could just subtract 60 basis points. The way the tool works, subtract it right off of CPIU. And what do you get? You get like 2.8. You know, we probably would have been down at like 2.5, 2.6. We would have been cutting already probably. I mean, I don't know. I don't know any better than you do, but I know that if inflation was 60 basis points lower than it is right now, then we would be having a whole global economy would look different as the trading mindset, all of this stuff. And it's driven, this is the tragic comedy part of it, is driven by this one random, unique, idiosyncratic thing going on, which is also potentially highly polluted by measurements because it's not being replicated in PCE. And to make matters even worse, check this out. So PCE, their measure of auto insurance, like the actual year-over-year inflation, they get that from the BLS PPI side of the fence, right? So you have two totally different measurements. One's coming from PPI, one's coming from CPI that are telling totally different stories, which again, you could read into that and say, oh, well, that's just the profit that's being taken in between the two. But again, when you dig into the methodology, it is not that clear. Like the methodology looks very similar for the two of them. So that's one of the outstanding things. I just have not been able to track that down. And frankly, I'm hoping more people that listen to this will start asking that question because it is just such a large, random, and frankly, stupid driver of these metrics, which everybody is hanging on the thread of, you know, every single month.
Right. So CPI, that's what a lot of mainstream people outside the Federal Reserve focus on. PCE is what the Federal Reserve focuses on. So just to put a point on it, you're saying, so year over year, April CPI, Consumer Price Index, was 3.35%. 60 basis points of that was auto insurance. So CPI, if there was, if there was zero inflation, that would have been 2.75%. So only 75 basis points above the Fed's metric. Of course, the Federal Reserve, sorry, not the Fed's metric, but above the goal of 2%, although that goal is for PCE. Now, okay, so in PCE, I'm seeing portfolio management and investment advisory services. So that's only 1.37% of PCE price index, but it is having a 12 basis point. It's responsible for 5% of inflation. So I guess it's not as big, but it's
not as big. No. Nothing. I mean, that's the thing about PCE, which we've also written on this. Again, all free on our website. It's so diffuse. And this is actually one of the reasons why, the Fed in 2000 said, like, we prefer PCE over CPI, over policy purposes. It's just because there are so many components and the weighting is all much more distributed and it's like less top heavy. And that's only grown more to be the case like over the years. And so the issue with PCE that we have right now is that, as we were coming out of the post-COVID inflation, there was all this cycling effect, right? So, we were, seeing wonderful kind of year-over-year numbers as like we were just cycling these crazy numbers. But now you've largely lapped a lot of that. And what I do every month is I basically just rack and stack all of these, like 185 different items or industries that I have in here. No, items, sorry, piggyback on labor. And I just rack and stack and I'm like, what was the highest inflation impact, which is imputed rental of owner-occupied non-farm housing, probably 60 basis points, all the way down to the lowest. And I say, okay, what was that for the prior month? It all adds up to your 2.65 or whatever. Now, what is it for the current month? And just subtract the two. And what you'll notice is that I would say like 90% of all the items are zero. Like there's just no change from month to month. And this kind of speaks to how diffuse this thing is. It's just like you have to have so many of them moving in the right direction all together in order to see like the types of changes and the types of compression that we saw over like the prior year. And now you're to this point where it's like everything's just kind of like settling, And so then you have like last month, people got all excited because inflation went from like 2.7 to 2.6 or something like that. I don't know, 2.8 to 2.7.
2.7 to 2.65. Yeah.
Yeah, and so we wrote a report on this, and like the largest single driver was a lower or more deflation, just slightly more deflation on used.
That's what I'm looking at right now. Used light trucks.
You won't be able to see that. Oh, what that was? Man,
yeah.
It's like we planned this or something. That's great. So it was slightly lower deflation. You can barely see it towards the end. You see how it kind of like ticked down in that last month? Well, that was basically responsible for the entirety of the change. But go back to used light trucks and look at the standard deviation bands. So my point is like, look, I don't know of any economist or data person that's going to come in here and be like, I'm going to tell you where the used light trucks are going, right? Especially knowing that these metrics are all just like they're derived from random measurement processes and everything. So even if you did know what used light trucks are going to be, that doesn't mean that you're going to know anything about this measure. So the best way of predicting the measure is just to look at the historical data, as it will be very representative of the measurement bias, so on and so forth. And so I look at that and I'm like, all right, it bumped down a little bit. It's plus or minus 1 standard deviation. My takeaway, nothing happened. So the whole last month was like a whole lot of nothing. The prior month before that, again, a whole lot of nothing. Everybody, was freaking out about PCE going up. It was all gasoline. You can kind of look at all of this from month to month and be like, wow, like we're kind of stuck with PCE. And that's where I think the discussion really needs to go because, we're being told a lot, just wait. Policy effects take time. And that may be true. But you know what we need to drop? We need OER, this imputed rental of owner-occupied residence. We need rentals. We need those to drop. And I think people are losing confidence that we just wait longer and those go down. But that's the real big kind of sticking point that's like preventing us from getting down to the low twos is these dropping back to any semblance of normalcy going back in history. And think about it. If I called you up and I said, hey, how much can you rent your house out for? And then mortgage rates went up. Like you would actually say more than you did the prior month. So like the whole causality is really backwards now. It's very hard to kind of figure out if rates even matter for this beyond the measurement issues with it.
Your point that inflation is going to be sticky to the upside because it consists of so much of owner equivalent rent and actual rent, that makes sense for me for CPI, which is not the Fed's target. So owner equivalent rent is 25.4% of CPI and actual rent is 7.5. So it's a bit 34% of the CPI, and that is going to be sticky and super lagging. I get that. But when it comes to the PCE, which is the Fed's target, it's much smaller, as we pointed out, right? It's 5.72 and 5.37. So it's 11%. So are you saying your point stands for CPI, but not PCE, or
No,
both?
it stands for both. It stands for both. It's still like, because, if you're stuck at the 2.7 range, you got to look at where's like the lowest hanging fruit. Where are the biggest bubbles that we can work on in order to get them down? Because everything else is largely, I shouldn't say everything else, but a lot of the other stuff is really settled, as you'll see in the tool. I mean, you're not going to get much out of food inflation at this point in time. I think that statement that I made about we really need OER, imputed, whatever it's called, and rental of residences, it applies to both PCE and CPI. Because PCE, unless we're okay with PCE being at 2.6, 2.7, because you start losing candidates on like, where else am I going to get deflation from, right? Healthcare is a huge component within PCE. It's far larger in PCE than it is in CPI, which makes sense because PCE is supposed to represent the entire economy's perspective of this category. And think about, we talked about Medicaid, we talked about Medicare, we talked about the employers that are paying for your commercial insurance. Like, there are a lot of other expenses incurred outside of what you personally are incurring. Whereas within CPI, that's supposed to be from the consumer perspective. So you look at that, and those numbers are starting to accelerate a little bit, at least in CPI. Or, it's, from all of the discussion that we have, it's probably, I wouldn't place a bet that, we're going to look at medical care for deflation going forward. And so if we need to go from 2.6, 2.7 down to, like, say 2.2, 2.3, what I am telling you is that even though it's a smaller impact relative to CPI, this OER and rents, it's still far too large relative to where it's been in history. And so those really need to come down, because you're going to get the most. You'll get 10 basis point chunks out of that once that starts coming down. Whereas everything else, it's really hard to get it to move by more than like 1 or 2 basis points a month. Does that make sense?
Yes, that does. Tell me about healthcare in PCE. I know that there actually was, in some months, recorded instances of massive deflation in healthcare, which is not the experience of anyone actually alive, but for some reason the formula did that. Was that in CPI or PCE? And also, I'd be grateful if you helped me to find the bubble, because I'm struggling.
Well, flip over to CPI and you'll find the bubble.
Okay.
That also tells you how different these measures are. So if you looked in the tool, and especially like the tool allows you to rewind time, right? So you can look back to 2022. And one of the things that I've also been talking about a lot is that health insurance was massively deflationary. Like, we're talking about, I think it peaked at like 35% deflation or something within CPI. It's probably not as big right now, but if you kind of like flip back, go back to, I don't know, somewhere
health insurance,
the end of last year.
Yeah, here we go. What is
insurance right there? What wild chart? Okay. I cannot tell you all the nuances of this, but I did talk to the BLS, and I'm like, what's going on? And they're like, this is the one item that is measured differently from all others. Like, this is, everything else is kind of a nominal price increase. This is taking into account experience. It's taking into account usage. There's a whole rat's nest of methodology to dissect within health insurance. Needless to say, as you can see, it got thrown completely out of whack. Whatever the methodology was, it got super distorted because of COVID, right? I don't know why, but it did. Like, that's the data says. And what's happening now, and I've actually forecasted this, it's reversing out, right? So if you look at the month-over-month change just in the index for health insurance, it's going up now. And so we are rapidly kind of cycling out of this deflationary environment for health insurance, and it's normalizing back to where it used to be, which is like, moderately inflationary or something. And I believe that probably by the latter part of this year, this is going to flip from a good guy. And remember, if you go back to that number, you can see how much of this. So in September 2023, we put up 3.7% for CPIU all items. Hover over the health insurance bubble in that chart, and you'll see that that was an inflation impact of negative 0.342. So that was a good guy of 34 basis points. So if that were 0, then we would have been over 4%, right? And so we have good guys last year that were based on these weird methodology type of things going on that are now reversing out. Plus, you also had kind of like an artificial kind of, I'd say, kind of lull in insurance within hospital costs. you'll see if you flip over to today or
Mm-hmm.
April, whatever the latest data point is, you'll see hospital costs are really starting to assert themselves. It's one of the big bubbles there. And so that's now 15%, inflation impact. It's a pretty big deal. So healthcare is going back to doing what it does, which is inflate faster than the economy. And that is kind of making it harder, I think. So all this downward pressure, any downward pressure that we get on OER and rents, we have to look at the other side of it to say what's happening to health insurance, because that was a weird anomaly type of situation going on. And that is reversing itself out at this point in time.
And Eric, safe to say that the massive deflation of 30 to 35% in health insurance of September was not experienced. It's not something you would experience if you're a consumer of healthcare. It's only in the data.
Okay, so I would challenge any human being living in this country to say that they had 35% reduction in their premiums. 35% increase maybe, but reduction, it just, no. But now, and here's the other thing. Flip over to PCE, and it's going to be hard to find in the tool, so you don't have to do that. But I also did write about this. I put up on the website, when we published the PCE tool, I put a comparison of health insurance within the PCE measure and the CPI measure, and they don't look anything alike. And they never have. Basically the PCE is like it's almost a perfect straight flat line of some modest amount of inflation. And then CPI is it's all over the place, right? So that further makes me just step back and be like, I have no idea what they're pouring out of this blender at this point in time. But it is heavily, heavily distorting these numbers. And again, kind of, stepping back, it really, my words, it's concerning. Right? That it's like, what is reality at this point in time? I don't really know. I just know that, you have a whole bunch of somewhat arbitrarily measured things that the nature of what they're trying to do is very good and pure with all sorts of adjustments. And you pile them all up on top of one another, and we end up with a number that then we call inflation. But it's not inflation. It is the measure of inflation. And so then the next question is well, what is inflation? And then it's almost impossible to answer that, right? Because you have to get into, which one of these items do I actually trust and which ones do I not? And then the whole thing kind of falls apart. It's like a house of cards.
There's a sentiment out there that I want to seriously, consider and give fair hearing to, that actual inflation is not being measured by the measures of inflation, whether it is CPI or PCE. And I think there are at least three reasons for the disconnect. One is everyone lives in their own inflation universe. So if you have 6 kids that you're all sending to liberal arts school and education is increasing 20% year over year, the fact that cereal and televisions are cheaper now than they were in 1990s doesn't really mean that much to you. And so your personal inflation universe, your actual inflation is much higher than CPI, doesn't mean that CPI is inaccurate for the aggregate. But there is no aggregate. No one is the average person. So that's reason number one. Reason number two, and this I have been hard on people for, perhaps too hard, is that people are wrong about the understanding what the meaning of inflation. Some people are. They think that inflation means that if the prices went from 100 to 120, that there's still inflation if they stay at 120. When actually, if they stay at 120, there's zero inflation. It's the rate of change of prices, not the level of prices. So I understand the confusion, but the economic definition of inflation is just not that. And the third thing is the actual discrepancies between reality and fact, which sometimes may be overhyped, but I'm so glad that you're here to really do the deep dive here. For example, inflation in healthcare inflation, healthcare insurance inflation. Last year, there's almost no way to say it other than it was massively underreported. Healthcare prices probably increased, and they probably increased a lot, and they definitely did not decrease by 30% year over year. Likewise, when it comes to owner-occupied rent, that's pretty laggy, and it's kind of a fake measure. So maybe that overstated inflation. So you have one measure being too hot, one measure being too cold. You put everything together, maybe that actually gets to the theoretical aggregate, but I don't know. So I just want to say that, maybe people, maybe people are right when they say that CPI and PCE is not measuring reality.
I totally agree. I think that there's that discussion. There's also the discussion on healthcare, and even, some of these other services like management consulting and everything. It's like, what do rates actually have some sort of direct control over, or even like somewhat indirect? And what do they not? And then why are we looking at these highly aggregated, amalgamated measures that are combining a whole bunch of things that the Fed has arguably very little control over, with things that they do? And then saying, well, we have to look at this one measure to then decide what they are going to do. And in reality, I mean, maybe behind closed doors, they're actually like, look, we can't control any of this kind of stuff. But like the market perception, they're not helping the market perception, right? You know, and again, this is just me speaking, this is not bank reading. But it does not help after a CPI print for a Fed governor to come out and say, we still need more work. We have to wait for multiple inflation prints. Like what would be helpful is like, that metric's garbage. We've told you a million times that we look at PCE. Maybe we need to wait multiple months for PCE to go down, but why are you even paying attention to that? We told you back in 2000, but we haven't changed our mind. So I don't understand why they are feeding the confusion or sowing more confusion by lending credence to this, besides the fact that they're painted into a corner and they have to because politics or whatever it may be, or people looking at this number and getting so much media and press and whatever it is. But I think that could be very easily dismissed in a much stronger way by saying like, look, come on, everybody knows, like, look at this measure at this point in time. Like we've already told you, this is not what we look at. So let's all focus on this number. And if that's sticky and we need more months of that, just be more precise. Be more precise with what you're looking for rather than kind of leaving this as kind of like this like choose your own adventure mystery book that we're all trying to figure out, you know?
That makes a lot of sense why PCE is a better metric. But I also think one reason why Fed governors, Federal Reserve members are reticent to go out there in front of the microphones and say, CPI doesn't matter. CPI is higher than PCE, but we focus on PCE is maybe some of them did that in 2021 when CPI was higher than PCE and they said, focus on PCE, and then PCE went up. I think that the transitorians had a lot of egg on their face. And, you know, so that I think that could be a background.
Well, you know, Jack, it's never too late to do the right thing. So, I don't know. I mean, like everyone's painting into a corner here, right? I get that. You know, there's the, like, this is what we should do. It's easy for me to say, you know, talking to you, but I get there are way more variables that behind the scenes, but we're just in a tough spot now, right? Because, you know, all I'm doing is looking at the math. Like we put out a report. I think the title of it was, can the US achieve 2% inflation without housing cooperation? And the report was, you know, I'm giving you much more of my personal views than I did in the report. The report was very much focused on the data. It was basically like, look, okay, late last year, the rate of sequential inflation, month-over-month inflation in like OER rents, it was softening. This is really good. Like this is like 30 basis points a month. I'm like, this is great. Okay. Then I step back. I'm like, wait a second. If I annualize that, what does that come to? And I'm like, it was like 3.7%. And I was like, that's still kind of high. Let me go back over the history of all the data going back to 1960 and see how many times have we been able to get sub 2.5 headline inflation, not core, headline inflation, when housing inflation was at this kind of low level, like the 3.7 level, annualized rate. The answer was there was 1 month in the history of the data. And that 1 month had this like artificially very low energy inflation and immediately reversed out the next month. So there is no precedent in the data for even like us to hit 2.5 or below, given the weights of CPI, even if we moderated, you know, on a month-over-month basis in shelter. And we have not stuck that 30 basis points a month. Maybe last month it came down to like closer to that level, but we were at like 50, 60, you know, earlier part of this year. And like, that's just not going to cut it. Like that basically just takes my analysis and puts it on steroids. So like, we really needed to come down to like the low 20s, like 20 basis points a month. And once we're settled there, then eventually you'll cycle your way out of this and cycle your way towards like, okay, I can actually see getting to 2.5. But right now there's just a really big math problem. It's not like a forecasting problem. It's not a wait longer problem. It's a math problem until OER and rents crack and then motor vehicle insurance starts to behave.
Yeah, I mean, I think that the most nonsensical and potentially misleading part of CPI is owner equivalent rent. I don't know for this for a fact, but I think the background could be that inflation used to be measured by how much a house cost and how much it costs to finance that with a mortgage. But the issue is, no, if housing prices go up because there's a real estate boom, then that increase in an asset is being it's not necessarily a consumer price index. If everyone is just speculating on real estate. Number two, if the Fed raises rates and mortgage rates go up like they did for Volcker, then it looks like there's massive housing inflation, which is real. There is the actual cost on the ground, but I can understand why OER came to be, but it's really something, isn't it?
Yeah, it really is. I mean, we're in a tough spot, right? And I think that the more people know that, the more we can really start talking about the true nature of the problem, which is like, okay, ultimately the Fed needs to make the right decision, but should we all be looking at these metrics, or are they too far gone, or have things changed, right? I mean, a lot of I was looking back and the definition of core inflation I think came up in like the late 1970s. Well, that was coming out of like the oil crisis. Like, does that still apply to a world where, the Exxons and the Shells of the world are taking all their money and throwing it into buybacks rather than drilling? I mean, I don't know anymore. Should food be stripped out? I went back and I looked at the actual volatility. We've been told these are more volatile categories. And in some cases they are. But the volatility, if you look back in the true measure going back to 2007 of the food and beverages category, was exactly the same as medical going back to 2007. So is it really more volatile? Or are we just working with outdated measures, outdated definitions that we need to be has the economy changed in the last, 50 years, 40 years? Maybe it's time to revisit some of these things and make sure we have the right measurements. What did Peter Drucker say? If you can't manage what you can't measure. I feel like that we're stuck with that right now.
And another saying is that when a measure ceases to be accurate when it becomes a goal. So if everyone's targeting a PCE of 2%, then maybe the measure isn't as accurate. Eric, by any chance, do you know how the weighting of owner equivalent rent has changed over time? Because I pulled up what the actual reading of OER was since it started in 1984. Surprise, surprise! Right after the inflation, Volcker raised rates in 1981. Yeah. It briefly dipped negative in 2010, but pretty much 2008 and before, it was always above 2%. And before 2000, it was average. It appears to average in the 3%. So it's interesting to me if OER weighting was still as high that, we've had this problem before.
I looked at that very early on, and I'm actually looking to the side because I'm trying to pull it up right now, but I could also show you how to pull it up if you want to. So if you go to the Bank Creek, I'm going to the Bank Creek Inflation CPIU visualizer.
Yep.
I can't go as far back in time as you probably want, but in this viz, if you scroll all the way down to the bottom on the date filter, you get down to January 2005. And then if you click on owner's equivalent rent of residences, it basically says that the prior year relative importance. So relative importance is BLS parlance for weight. It was 23.38. So it was still really high. I was actually really surprised by that. I thought that it would be, I guess this is also recency bias, right? Because I'm like, oh my God, this has gone up by so much. It must be way lower. But then you remember what happened in 2008, where this just got hammered and it was depressed for, you can look at the trend chart. Right. It was just really, really depressed for quite a long time. And so the weight did not make any progress until we actually really started coming out of COVID, up until then, you're talking about 3% inflation, that's not really inflating much faster than the rest of the basket. And so it does make sense that the weight hasn't progressed that much. So it's always been very, very high, I think is the point.
So yeah, in 2005, it was 23%. Now it's 25 point something percent. So it hasn't changed from us 2005, maybe the 1990s, but that'll be interesting to look at. Eric, I just want to put a point on, you're saying that with housing inflation running where it is, there's only 1 month in history where we have data where housing inflation was running sufficiently high where it is now, where inflation was at the Fed's target of 2% or below. Do I have that correctly?
Yeah, no. So, I was being generous with the analysis and optimistic. So when I did the analysis, I was looking at the run rate from Q4 of 2023, when we were kind of down in a low 30 basis point month over month increase for these major housing components like the OER rents. And I was doing all the math based on that. hopeful that it would continue to settle there because the data did look like it was settling. And then all of a sudden what happened was like January, February, March, it shot up back again, which is concerning, right? On a month over month basis. Sadly, I don't give that to you in the visualization, but if you pulled this data and you looked everything month over month, you'll see that that actually went up. And so we're worse off now than where I was when I did the analysis. So I can safely say that there are no data points in history. And that goes back to the beginning of 1960, because when you actually look back, and we have another tool that you can look back at CPI all the way back to like 1920, 30, or however, early the BLS publishes it for overall. Well, what you'll see is that different kind of levels of granularity will start popping on over time. And I think the housing one started in 1960-ish. And so we only go back to then. Before that, there was no data, so I couldn't go back any further in that. But yes, from where we are now, there is no historical precedent that we can get below 2.5. Like forget about 2, like anything below 2.5.
That's fascinating stuff. Eric, thanks for coming on and sharing this. I learned a lot, and I think I'll learn more, and people will learn more if they actually use the tools. It is really empowering. Eric, just quickly tell us a little bit about Bank Creek, as well as what do you do there when you're not, constructing these massive data tools?
Yeah, so Bank Creek's an investment management firm. We were founded in 2021 by my best friend, actually. I've known him since 3rd grade. Actually, the name Bank Creek came from the elementary school we went to, which was named Banyan Creek Elementary down in South Florida, where we played the stock market game. So I figured, why not pay homage to that? He worked for a family office for several years, kind of developing what we thought was a pretty interesting and unique investment strategy, public equities. So not on the macro side. It's very different from this. Ended up leaving the family, and the family was very supportive of him going out and supported us in building the company. We initially started working mostly on the private side, SMAs for clients, so on and so forth. We had a couple commingled vehicles, or have a couple commingled vehicles as well. And over that period of time, we also have a chief data scientist. His name is Anton Yen. And he had been in the background. This is where kind of the connection is, I think, between what I'm doing and what he does. We both love working with data and are very deliberate and intentional with how we work with data. So he was working on, how do I take the mental model of Andrew Skadoff, who's the founder who developed this strategy when he was working for this family, and how do I actually turn that into algorithms, for lack of a better word, and make this into a quant strategy. And initially when he came up with that idea, now he's like, used to work for Lawrence Livermore and is a brilliant dude. When he came up with that idea, I was like, good luck. Many people have tried, many people have failed. Well, 3 years later, after a lot of work and a lot of model evaluations, we evaluated billions of different model iterations and so on and so forth. And he had come up with something that was extraordinarily compelling. And so we looked at it and we said, you know what, like we actually could deliver this to the public markets in form of an ETF. Before it was too labor intensive, and this version, we could do it in a fully quant fund, to focus on finding long-term structural compounding businesses, but do it through quant. So it's like it was very different, like apply quant to long-term investing. It was really cool, like really unique idea. And everything that we did supported that this was going to be a very compelling product. So middle part of last year, we started kind of, the process of getting all that ready, which was a painstaking process. And we launched our first ETF towards the latter part of last year, which focuses on, it deploys these unique tools, algorithms, this engine on US markets. Fast forward another 3 months to March, and we decided that we wanted to take this and point it at non-US developed markets, because there's just a dearth of opportunities to find, high quality structural compound businesses outside of the US. International investing is just not in vogue at all. And so we're like, we can use our tools in order to do that as well. So we have those 2 public offerings, those ETFs. And at the same time, we were having this internal discussion of like, okay, we've never needed a public facing kind of image or anything like that. We never had an advisory site. Everything we did was on the private side. And so I raised my hand and said, hey, look, I don't want to just put a bunch of platitudes on a website. Like I'm just not, it does not get me interested at all. And so, but I had been building a lot of these visualizations because I did it in prior careers and everything. And so this is just something I love doing. I've been doing this for quite a while and been doing it internally and putting it in annual letters and stuff like that. And so I'm like, let's just go ahead and put these out and deliver them to the public. And that way, people can decide, hey, we're really interested in your investment strategy. And, maybe you can help us that way. Or they can say, we're not interested in your investment strategy, but we still have something that we can offer. And because ultimately, at least, I've been in some professional capacity for 17 years. And a lot of this is about kind of the meaning of the work that I'm doing. And so it does mean a lot to me to be having these discussions with you, to be, helping people better understand the data, to improve education through this data. And then look, if that builds our brand on the side, fantastic. If people get curious about us and go read our prospectus, fantastic, go do it. But you don't have to. The point is you don't have to. I mean, I personally am really just looking for how do we be of service to this crazy, ridiculous, bonkers market. And that may be through just better education and transparency, better tools. I mean, if your listeners are more interested on the macro side, like that's probably where we're going to be of service. And then, or it could be on like, we're looking for an alternative to spies. So, and then that's where people may read up on what we're doing and be interested on that side. So that's where we are. And I just love the ability to, I'm just grateful to my colleagues that they supported me because I mean, clearly like this is, it's a side project, right? And it's become a very time intensive side project, especially the more media attention we get and everything. But I think we've all seen it's very necessary. Like if we're not doing it, somebody else has to do it because it's frankly shocking to me how, I came in and I didn't really start working with this data like in the weeds until the beginning of this year. That doesn't make any sense. Like, why am I the one putting this stuff out? Like everybody has their eyes on this data and the data is all there on the BLS, BEA. It's there for consumption. And I mean, maybe this stuff exists behind paywalls. I don't know. Maybe we're the only ones dumb enough to actually put it out for free, but it should be there, even just to improve the discussion that we're having about these really important topics rather than just chasing our tails,
Absolutely. Eric, I'm really glad that we got in touch, that you created this tool, and I'm glad that hopefully our audience will get a chance to check them out. We'll share the tools, the PCE one, the CPI one, as well as the job market one in links to this podcast. And thanks again, Eric, for doing it. Thanks everyone for listening.
Yeah, thank you so much for having me.
Thanks for watching. Remember to check out vaneck.com/moatfg to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.